Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business filings. And let me tell you, this latest report from PennyMac's Financial Services has some interesting moves in the lending market. Now, why should you care about a company like PennyMac, which deals in mortgages and other financial services? Well, their financial health is a big indicator of how the housing market is doing, and by extension, how your own investments might be performing. Today, we're diving into their latest report to see what's really going on. Before we dive in, if you like getting these company insights straight from the source, make sure you're subscribed. We also have a Discord community linked in the description below to continue the conversation. Alright, let's get right into it. This document is essentially a heads up to investors about something important that happened on August 7, 2025. It's from PennyMac's Financial Services, a company you might know for its mortgage lending and servicing. They've got their own filing number here, 00138727. It's like their own little ID in the vast system of corporate reporting. And this symbol PFSI is what you'd be looking for if you wanted to trade their common stock on the New York Stock Exchange. So what's the big news? Well, according to the report, PennyMac's Financial Services announced that they're raising quite a bit of money. Specifically, they're issuing what are called senior notes. Think of these like a loan the company is taking out, but instead of one bank, they're borrowing from many investors. These particular notes are for a whopping $650 million, and they're due in 2034. That means they're promising to pay back the loan in about 10 years from now. And the interest rate of the cost of borrowing this money is 6.75%. This tells us how much the company is willing to pay to get its hands on this cash. Now, this isn't just a casual announcement, it's a formal filing. Issuing debt like this is a common way for companies to fund their operations, manage their cash flow, or even invest in new projects. For PennyMac, this likely means they see opportunities ahead, whether that's expanding their mortgage business, acquiring other companies, or simply strengthening their financial position. The details of this announcement are in a press release, which they've also filed. This is pretty standard practice. Whenever a company makes a significant announcement like this, they usually issue a press release to the public and then file that release with the Securities and Exchange Commission, or SEC. So everyone has the official record. So Corinne, so what does this all mean for PennyMac and for you as an observer of the financial markets? First, raising this much money suggests confidence. A company wouldn't typically want to take on significant debt if it wasn't pretty sure it could handle the payments and if it didn't have a plan for that money. This hints that PennyMac expects a stable or growing business environment in the coming years, at least enough to manage this new debt. Second, the interest rate of 6.75% is really important. How does this compare to other companies or to what PennyMac has paid in the past? If interest rates in the market are generally high, then paying 6.75 be standard. But if rates are low, it might suggest PennyMac has to offer a higher rate if the company ever faces financial trouble. An interest rate in this range is often seen as reasonable for a debt instrument of this type. The notes are denominated in US dollars, which is expected for a US-based company like PennyMac. This just confirms the currency of the transaction. This filing, in essence, is a snapshot of PennyMac's strategy to secure capital. It's how they signal to the market that they are actively managing their finances to support their business goals. For investors, seeing a company issue debt can be a signal of growth, or at least a proactive approach to financial management. Now, let's think about what this means in the broader context of the housing market and the economy. Mortgage companies like PennyMac are very sensitive to interest rate changes and the overall health of the housing market. If they're borrowing money now, it implies a certain outlook on those fronts. They might be anticipating continued demand for mortgages, perhaps even seeing an opportunity to refinance existing loans or issue new ones at profitable rates. On the other hand, taking on debt always comes with risk. If for some reason the housing market cools down significantly or interest rates spike unexpectedly, PennyMac will still have to make these debt payments. This is why it's crucial for them to have strong cash flow and a solid business model. The report also lists the exhibits, which are the supporting documents. In this case, the press release is the main exhibit providing the specifics of the debt issuance. And this last exhibit, number 104, is actually a technical file used for interactive data formatting in SEC filings. It's the digital wrapper around the information. The signature at the end by Daniel S. Perotti, Senior Managing Director and Chief Financial Officer, confirms that this report has been officially reviewed and approved by the company's top financial leadership. So to wrap it up, PennyMac Financial Services is raising a substantial amount of money through debt financing. This is a strategic move that signals their plans for the future and their confidence in their ability to manage this new financial commitment. It's a move that deserves attention from anyone watching the financial services and housing sectors. Now, let's look at this from a higher level, like Warren Buffett might. What's the story these numbers are telling us? PennyMac is essentially saying, we believe we can grow and we need capital to do it. They're issuing debt, not equity, which means they're not equity, which means they're not equity, which means they're not selling more ownership of the company. This is often preferred by management as it doesn't dilute existing shareholders. The risk here is clear. If their business doesn't perform as expected, those debt payments become a burden. This could squeeze their profits or even lead to financial difficulties. The opportunity, however, is significant. If they use this capital wisely, perhaps to expand their loan origination, improve their servicing technology, or enter new markets, they could see substantial growth in earnings. A key thing to watch for is how this new debt impacts their debt to equity ratio and their interest coverage ratio in future filings. These metrics will tell us if they're taking on too much risk or if they're managing their leverage well. Right now, this filing is a positive signal of proactive financial management and a belief in future growth. It's a calculated bet on the ongoing demand for housing finance. What's your take on PennyMac's decision to raise $50 million? Do you see it as a sign of strength or potential risk? Let me know your thoughts in the comments below. If you found this breakdown helpful, smash that like button and subscribe for more straightforward financial analysis. And hey, if you want to join a community of folks digging into these reports, our Discord server is linked in the description. Thanks for tuning in to Corporate Dakota, and we'll see you in the next video.